So the big headline today, 6.1% fall in the S&P. That's a huge day. That's a very large day down. However, we did not actually get halted. The market gets halted at a 7% drop, and we nearly got there. I think we were about 50 points away, but not close enough to get halted. I do have a long position, and we'll talk about that later in the video, and we'll also review today's price action. First, I want to talk about history, have a little history lesson. So look at today became the second largest point drop in history. And yesterday, it pushed yesterday out. So yesterday now is the third largest point drop in history. The only day to have more of a loss of points was during COVID. Now, look at this COVID crash when on March 16th, the largest one-day drop in terms of total value was on March 16th. What was the day after that? What was the day after the largest drop in history? It was the day after was the seventh largest gain in history. All right. There's more examples in here. So let's look at March 12th. March 12th was the fourth largest loss in history. What was the next day? The largest gain in history. The largest gain ever in terms of total value happened after the fifth largest loss. So that's important. There is a historical precedent for the market rallying after having a surprisingly strong sell-off. Let's look at this chart as well. So the largest daily percentage loss. So, I would argue that this is even a more important chart because it's actually the percentages, not just values that are kind of based on inflation. This is actually the percentage loss. Let's look at the number one loss, the infamous 1987 crash. 20% was lost in one day. What was the day that followed? Well, 2 days after the largest drop in history was October 21st. This was a Wednesday, and that became the 11th largest percentage gain in history. 9%. So people that were buying after the largest drop in history were able to make it 9% in one day. So there's more examples here. There's the Great Depression. You see a lot of 1932s in here, 1933s, and then you also see a lot of 1933s, 1932s on the biggest gains in history. So I'm bringing that up just for the historical precedent that the largest, it's just facts. A lot of the largest percentage gains in history happen after some of the largest percentage losses. Let's talk about the VIX. I've been mentioning that a switch gets clicked when the VIX goes above 35. Computers catch onto it. The funds that trade, that's like they're aware of that, and that's when they turn on the buying. The buying has not kicked in yet, but if you watch the video I made on when to buy the dip, it shows the past few examples of when we have gone above 35. Either the market immediately began to rally and rallied for a few days, couple weeks, or longer, or it went sideways to down for a couple days and then had a rally. So there, in two ways, we have precedent for there to be buying at this point. Now, of course, I can't say exactly what's going to happen on Monday, what's going to happen next week, but what I'm doing is dipping my toes in, and I am starting to take long positions. And if the market heads lower, that's okay. I'm trading small enough that I can buy more comfortably, and that's not going to be an issue. But we'll talk about it a little more at the end of the video. Let's review some trades. Now, this day was so large that, when I'm marking these trades, I'm marking them just assuming this is more of a regular day. So like this bar here I have marked, that's a 50-point bar. Okay, so I have it marked as a short. How many people are going to be selling below a 50-point bar and having their stop way up here? Not too many. And if they are, they're trading very small. But pretend that this price action is more of a normal day, and then we're really just looking at the price action and what's going on. And so that's how we'll kind of look at it. And I'm going to mark more, but I kind of wanted to mark some of the key parts that I was looking at. The open of today looked a lot like the open of yesterday. Yesterday, we gapped down, bull bar in the open. We ended up getting a double top. Then a bear bar that led to a swing down. What happened today? A bull bar in the open after a gap down. We have a double top. And then this is lower than this, but effectively it's still a double top, especially after this reverses down here. And bear bar. And that's why I have that marked as a short. Say we've been in this strong bear trend. We're at a double top. Second entry short, so first entry pullbacks, second entry short. And to me, that's a good short. I would not want to be taking it for a scalp. I'd rather take for a swing trade. When the market is clearly strong, it's best to try to get more profit out of it. So you want to lean towards swing trading on days like this. And we also have room to the overnight low. So that's something that increases your chances that you'll be able to get out before your stop gets hit. Like I was saying yesterday, when the market was selling off in this tight channel down, it's difficult to be short, especially if you've already taken a first short and taken profits. It's difficult to get back in because right, you're so far below the moving average. It can be scary to sell down here. It doesn't change it doesn't change the price action. I hesitate on marking it because it is difficult to sell into these lows like this. But it's, if you're, just turn off your human brain for a second, thing like a computer. Bear trend, pullback. Any bulls that try to buy through here, they're going to be giving up below a bear bar. They're not going to want to be holding long after all the selling we've had. If there's a place to get out, they're probably going to take it. So another way you can look at this is a second entry long that fails. So first entry, so buyers buying here, pullback second entry, and then that fails. And then bears would be shorting below this bar. Same story with this bear bar. My concern here is that we're coming into a bit of a wedge pattern. So first, second, third push. And yeah, you could argue this is a failed wedge and that we'd be heading lower. I'd just be concerned so far from the moving average, then this could double bottom here and then head up. Ultimately, we did get one more leg down. But after I start to see a wedge pattern, I kind of get cautious on trying to continue to sell. I kind of go to the sideline when I see a wedge pattern forming. And same thing here. This is just another wedge. So first, second, and third. And you could argue there'd be buyers above there, and there were, and they would have made money. I'd rather not be buying during an open like this where it's so bearish, and the risk is so large. I'd rather just be waiting on that. I think it makes sense to buy, and because it makes sense, it's okay to mark, but you don't have that much room back to the moving average. If it's a wedge, you want to be taking a swing trade. There's your swing trade. And are you thinking, what odds are you giving this that you'll be able to get a profit above the prior high before the bear trend resumes? Not too strong. So I'd rather just wait on that. If the market has been like it has been, where it's very strongly bearish, then it's probably best to avoid trying to buy above a bull bar and have your stop 55 points below. But if the day wasn't so large, then wouldn't be too bad buying above that. Just like we had a wedge bottom, we have a wedge top. First, pullback second, and third. So we have 3 pushes here. It's failing at the moving average and a big bear bar to sell below. This bar alone is big enough to at least get a small second leg. So pull back second leg. Is that the second leg? Or pull back, like 2-legged pullback, and then second leg here, or finishing down here. Either way, we're expecting more off of that, so there will be sellers from this bar. And then after the wedge top, then there would be sellers, swing traders selling that as well. We have a triple top at this level. That's good for the bears. My concern is to be selling here. This needs to be a swing trade, and you're going to be far below these lows, so you have to be betting on a breakout here. And you can see it would have worked. If I have a big bar like that when it needs to be a swing trade, but I don't have room to get out before a low like that, then probably rather just wait on it. What about shorting here? You could argue for shorts here. Double top here, this high and this high. And then of course we have bear bars to short below, bear bars in a bear trend below the moving average. So that's all good. My concern here actually is over the past few months, we've had a lot of instances where we've had a sell-off and then a deep pullback that traps bears during at the low. So we'll have a move similar to this where there's a strong sell-off, then a strong pullback, and it looks like the bulls are trapped and the market is about to head lower. But really the bulls are able to get in a couple more traps before the market does end up heading lower. So this kind of pattern has kind of been etched in my mind over the last few months. And because of that, I've been avoiding selling in these instances. And that's just one way that you have to adjust to the market, is that it'll do something a certain way for a couple of days, couple of weeks, few months. And what had been working in the past might not work during this time. And you have to adjust to that. And then in the future, it'll go back to doing what it was doing. But until it does that, then you need to, you need to adjust what you're doing. The market, sometimes you can just play dumb with it. Whatever it's doing, then that's what you should do. You should just go along with it. You shouldn't try to outsmart it. If it's going down, you want to be looking to short. If it's going up, you want to try to buy. If something hasn't been working, bet on it continuing to not work. Or if something has been working, bet on it continuing to work. Another wedge top at the moving average. So, these are great. These wedge tops at the moving average with room to the lows. That's the way. That's the way to go. That's what you want to be looking for. That has been working, and that is for long. That's going to be. There's something underlying in the market that is just inherent, that this is where bulls get trapped. People that are buying here, betting on reversals, or maybe beginners that are buying. And I say beginners, but actually there's a lot of people that are running funds with a lot of money, and they really don't understand what's going on. Just because they're there and making lots of money, they're part of the club. And the club wants to protect themselves and take care of each other. Funds go out of business. They're not perfect. They lose money. So there are buyers here, and then they end up getting trapped. Wedge top at the moving average. They exit below a bear bar, and so that's kind of who is buying here, and then they're ending up getting trapped. So when you see these wedge tops at the moving average, it's a great place to try to be looking to bet on the trend continuing. And what about this last little bit here? Once again, another wedge, different ways you can draw it here. Then the idea of a short would be below this bar. It's so close to the end of the day. It's on a Friday. Just avoid trades in the last 30 minutes like that. So what about the trade that I have? I had mentioned that I have a long position, and I made a video about that this morning. So let me go over to the micro and the tick chart. I'll just stay on the I'll stay on the 5-minute chart here. So I bought this morning at 5,200, and I'm gonna take a profit at 250 points above. Then my stop, my stop is way below. It's like at like 3,000. So my plan is, one, trade small enough so that I could withstand whatever kind of pullback might happen. If I was to trade too large, then I guarantee if let's say we have another day down on Monday, I'd be saying, oh my gosh, I can't handle that big of a loss. Then I'd be exiting, and the market would have one of those historic days up. That's just how it goes. So, you have to trade small enough so you can be comfortable and be logical. I was explaining my position to someone else earlier today. This is what I'm doing here is more like when people buy the dip with stocks. When let's say Apple is pulling back, and they say, oh, Apple's been down for a little bit, so I'm going to buy it. Or any individual stock, people say, oh, the stock I like, it's down, so I'm going to buy the dip. And effectively, that's what I'm doing, but with futures. And I've made videos in the past where futures really is a great way to do that. Because you can trade small, but you can still achieve leverage. And I've made videos explaining the math here where as long as you are able to withstand a pullback, then your account can actually outperform the market. So if the S&P goes up 8% in a year, then if you were trading, for example, one E-mini, the math was if you have a $100,000 account and you buy one E-mini, on average, the S&P goes up 8% a year. 8% in the S&P 500, but if you buy one E-mini, that would be equivalent of a 20% return. So it's the same. You have the same capital, and you have the same. You're trading the same underlying, but your returns can be so much greater trading the futures. Now, once again, you have to be able to withstand some sort of deep pullback that might happen. But there are lots of opportunities with trading futures. So instead of doing individual stocks, you really can do all your buying of the dip, or your trend following with futures. So when people buy stocks hoping in 5 years, 10 years it'll go up, well, it almost always does go up after 5 or 10 years. And if you're buying futures, then it's going to be leverage, and you will have that excess return over if you were just buying the individual stock. So the key is that you just have to be able to withstand a pullback. So if you're buying already when the pullback is 20%, 40%, 50%, the U.S. stock market is unlikely to continue to have much more of a drop below that. And then your returns from there will be likely to be pretty great. So my plan, exit 250 points above at 5,450. If it goes to 4,500, I'll buy more at 4,500. If it goes to 4,000, I'll buy more at 4,000. And then I would evaluate from there. And if I need to hold on for even a couple years or 3 years, which I don't expect to need to, but if that were the case, I'd be fine with that, because once again, I'm effectively just buying the dip with individual stocks. Probably every person that's watching this has bought the dip already unknowingly. If you have a job, your employer probably has some sort of investment account set up, or you have your 401k. There's some kind of investment through your employer that you don't even think about on a weekly basis, but it's happening. During this dip, money was being taken out of your paycheck and being put into some investment account. So you are buying the dip as well. We are all buying the dip. So we're coming into a time of increased uncertainty. So what are some keys? One is that we cannot expect to know what's going to happen tomorrow or next week, next month. We just can't know. We just don't know what the interest rates are going to do, what the tariff news is. We just can't know. So trade small. Whatever trades you're taking, these bars are huge. I mean, some of these are 50 points, 60 point bars, and the gaps down are, overnight, or it could be a couple hundred points or two. I think one day that one gap was like 250 points. Yeah, this gap was 250 points. So trade small, do the math, and whatever the math says you should trade much smaller than that. If you're worried about how much you're risking, then don't take the trade. You don't need to be trading right now. You just don't. I mean, this is kind of, crazy time with the way stuff's moving. At any point, news could come out that'd be positive or bad. So you just don't need to be trading if you're at all concerned. I'm not going to give advice on what you should or shouldn't do with your stocks. I mean, I'm just saying what I'm doing is I'm not selling my Amazon stock. I'm not selling my Bitcoin. And as you can see, I'm actually adding on here with buying these futures. So I mean that's my plan. I'm eager to buy more as it goes lower, and we could be in for a larger move down. What does that mean? I'm not sure how much that could be, but clearly the market has responded very strongly to the tariff news. I mean, as I pointed out earlier, our past 2 days have been 2 of the 3 largest days in history down in terms of total value. So the market is responding to those tariffs. It takes that seriously. So what's next? We just can't know, but you just have to trade small. Don't be married to a position. Be logical, and don't let your losses grow too large. You have to live to trade another day. So I'll end by saying this. This may be a scary time for some people, but this is actually a great opportunity to learn. We get crashes actually quite often in the stock market. Every few years there's a sell-off of some kind. So if you're going to be trading or investing over even just 20 years, you're going to see multiple crashes. And this is a great opportunity to learn, to see, examine what you see around, what are the emotions that you see in people during this? What emotions do you feel in yourself? And then what do you see after that? After we have a big bear day, what do they say on the news? If we have 2 big bull days next week, starting out, they probably switch to saying, oh, this is a great buying the dip opportunity. The market's going higher. It's going up to 7,000. Even though right now they're saying it's the end of the world. And, the sentiment changes that quickly. You see it all the time. So examine that and study it. And like I said, we're having some very strong bearish days. So study them and understand how the market trends under these conditions. Take screenshots, save them to a file. And then, for all these days in here, or you can just take a screenshot just like this. Then you've got, you save your screenshot, and then you can also go down to individual days that you're interested in. So like we're we had that China news come in overnight. I'll pull it up. So the China tariff news came in at 6:10 this morning, and then take a screenshot of that and save it somewhere on your save it to like a trading file on your computer and title it China bearish tariff news, and then you see what happened. And then when something happens in the future, you can refer to these charts, and there's a good chance that the whatever emotions or psychology that was going on now is going to be the same in the future, and that actually could lead to there being very similar charts. So use this as an opportunity to learn. Thank you guys. If you have any questions on anything regarding this, just let me know in the comments. I'd be happy to answer. See you guys.